Verizon reported earnings before the market opened on Monday, and investors weren't particularly happy with what they saw. Shares are down about 6% as I'm recording early in the day on Monday. So we'll see how things shake out as the day goes on. But the headline is going to be that Verizon missed their revenue targets, the estimates the analysts put out, but hit their earnings targets. So what in the world is going on there? How can you miss your revenue targets but be just as profitable as analysts are expecting? And the truth comes down to where Verizon is growing and where it isn't. The strange thing about this quarter is that Verizon is growing in the right places and shrinking in the right places. Now that makes revenue look bad, but it's actually better for the business. So I'm going to dig into exactly what I mean by that. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. I want to start with a couple of charts that just show what estimates look like. This first one is the quarterly revenue estimate. This is what was missed in the quarter. And you can see here for the June quarter, the estimate was for $32.99 billion in revenue. Verizon actually reported $32.8 billion in revenue. So it seems like a really small miss, but when you're talking about a company that's going to grow in the low single digits, even a small miss can be pretty meaningful for the business. But I'm going to get into exactly where that miss came from and where there's actually some pretty solid growth in the business in just a second. So I'll put a little context behind that. On the earnings side, you can see here that expectations were for $1.15 in earnings per share. That's exactly what was reported on an adjusted basis. Again, I'll get to those numbers, but hopefully this puts into context exactly what was reported compared to what was expected from analysts. That's typically where that sort of first reaction by the market, the first few hours, even the first day or two, is going to come from what were analysts expecting and what was actually reported by the company. But let's dig into the numbers to show exactly what's going on. I'm gonna just run through some of the slides that Verizon gave for their earnings report. You can see here that wireless services revenue was up 3.5% in the quarter. This is actually where you want to see Verizon growing. I'm gonna get to hardware revenue in just a second. That's what was a little bit weaker. But as an investor, if you can choose anywhere that Verizon is going to grow, you want it to be wireless services revenue because they're spending billions and billions of dollars, tens of billions of dollars even per year to build out this wireless network. And then when they sell that wireless network, one monthly plan at a time, those monthly plans are very high margin. So this is going to be a very high margin business. That's why you want to see growth there. That's why 3.5% growth, pretty solid. Always would like that to be a little bit higher. But given the level of growth that we've seen in wireless overall, that's a pretty decent number. Adjusted EBITDA also up 2.8% and free cash flow up 3%. Free cash flow is a little bit volatile, and they're investing more in building out the C-band network, which will allow them to grow more, particularly in broadband. But that's going to drive some of those numbers. Broadband net additions, 391,000. And then they've been highlighting their postpaid net adds, which have been negative for quite a while. So 148,000 there and 12,000 losses on the prepaid SafeLink. So that's an improvement from where they were previously. This is the chart that typically gives a good overview of the company's operations overall. You can see that the consumer business, which has kind of been all over the map, about flat in the quarter. Business continues to be relatively strong, 156,000 additions there. And then this is what I think is the most valuable, because this is what's going to allow Verizon over time to be able to build more of a bundle, reduce their churn, and increase those wireless services revenue is by adding more broadband. And this again is going to be a very high margin business because there's not a lot of installation that happens. You just basically ship out a box that plugs into the wall. I've been using this for a couple of years now. So I think this is a phenomenal business for them to continue to grow. Prepaid continues to be negative, but that's not a huge surprise either. This is the chart that I think is most important. And you can see this red segment is consistently growing now, $27.8 billion in total services revenue, and then they break out the wireless services revenue here on the right. But what's down is this little gray column, wireless equipment, $5.3 billion in sales a year ago, only $5 billion in sales in the most recent quarter. The reason that's important is because of equipment margins. Here's a look at Verizon's overall consolidated statement of income. And you can see that they break this down into services revenue and wireless revenue. So a little bit more high level than just doing wireless services. But I think this is a good place to start looking at the business. You can see the cost of revenue from services, $6.9 billion. Revenue, $27.8 billion. So the gross margin on services revenue is about 75%. Compare that to the wireless equipment business. $5 billion in revenue, costs $5.6 billion, about a negative 11% gross margin for the wireless equipment business. This is why you want to see growth here in wireless services, and you actually want to see a decline in wireless equipment revenue. Now, typically what Verizon is going to do is subsidize equipment on the front end, and so that's going to lead to margin on the back end as people pay their monthly bills. That's the reason that you would be selling equipment. But this is also why you could report a relatively weak quarter from a revenue perspective, and it's not actually bad for the business overall. The other thing that I want to highlight here is the debt situation for Verizon. This has been something that has been an overhang for them. As interest rates have gone up, it's become more costly to service this debt. So total debt end of 2022 was $150.6 billion. That's down slightly to $149.3 billion. That's as they've invested in more 5G capabilities. Net unsecured debt, $122.8 billion from $128 billion at the end of 2022. So trending in the right direction. You're also seeing less leverage. Net unsecured debt to consolidated adjusted EBITDA, 2.5 times. Getting a little bit more efficient as well with their employee count coming down. So those costs are starting to come down, getting more operating leverage in the business. We'll likely see that flow more to the bottom line through higher free cash flow in the second half of the year. That was what management indicated. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So you can see this is how you pretty easily get to the point where you report a disappointing quarter compared to analyst estimates, but you dig a little bit deeper and the quarter actually looks pretty solid. That revenue miss was likely a miss because they weren't selling as much hardware as analysts were expecting, but they're growing pretty decently on the services business. And if you're analyzing this business as an investor, you want them to grow those services revenue and you don't want them to be selling hardware. So I think those are positive trends. Now, I would like to see some of these things continue. And some of the things that they talked about on the conference call is there was a price increase that was pushed through over the last couple of quarters. So that should help improve their margins. They did have a little bit of extra churn, but churn was still relatively low in the quarter. So they expect that most of that churn has been moved through the system. They're also increasing the capability to include broadband, so that fixed wireless access to more suburban and a little bit more rural areas. That should be able to expand their addressable market, increase that services revenue, increase those bundles. And then we're early phases in the new My Home strategy, which is going to bundle in a lot of those streaming services as well. There's definitely more progress to be made in the second half of the year, but I do think this was a step in the right direction. If they're successful in bundling these products together and making this kind of a triple play with smartphone access, broadband, and then streaming services as well, bundled all under Verizon, that's what's ultimately going to drive growth of the business. So I think this quarter was a lot better than a lot of investors are obviously thinking. Shares, like I said, down a little over 6% as I'm recording, but investors are now getting a 6.8% dividend yield for the stock. If management is successful in paying down some of that debt later in the year, if interest rates do end up coming down in the second half of 2024, we could see better than expected cash flow as they're actually improving their operating leverage and reducing risk through paying down some of that debt. So I like all of the trends at Verizon, but it is kind of a steady as you go business. The stock's actually up pretty nicely over the past year. So maybe just a pullback from changing expectations. But keep that in mind when you're looking at the headlines that say they missed estimates. May not be the full story once you dig into things a little bit more. Let me know what you think about Verizon's result in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.